Hello, and thank you for joining us for our quarterly webinar. For this one, Asia and I will focus on our 2023 outlook and what we're seeing for this year. Before we get started, we wanted to highlight a few things from last year. First, it was an unprecedented year. This chart shows the stock and bond markets dating back to 1976. You'll see in the upper right quadrant that 72% of the time, both bonds and equities are positive. 26% of the time, either stocks or bonds are positive, and diversification works. Last year was the only year since 1976 that both stocks and bonds were negative in the same year. Second, if you're in the equity market, you have to have a long-term perspective and be able to absorb short-term setbacks. Looking at this chart, even after including the dramatic losses sustained last year, your average annualized returns over the last 3, 5, and 10 years are still relatively healthy and intact. The NASDAQ was down 33% for the year, S&P was down 18%, but on a 3, 5, and 10 year, even including last year, those indexes are positive. Lastly, generally, when you get a decline of 15% or more like we had last year, we have above average performance moving forward, largely because we're starting from a lower point. But that should set us up nicely for the coming years.
The first topic we wanted to review and dive deeper into is the U.S. economy and our thoughts for what we anticipate for this year of 2023. Now, it is no surprise or secret that the U.S. will likely face a mild recession. In fact, when we take a look at recent headlines over the last year, it's been one of the most anticipated and most telegraphed recessions we've ever seen. As we look forward, we do forecast the U.S. to experience a mild recession in 2023. Outlined here in the yellow box to the right, we expect GDP to start slowing down as early as the second quarter and last for about 3 quarters. Our economists forecast GDP to be flat in 2023. So whether this number is slightly positive, flat, or slightly negative, it all indicates that the United States will have sluggish growth for this year, but it's not going to be disastrous like the pandemic or financial crisis. We believe 2 main factors will lead to a modest recession. First, there is a growing likelihood that the excess savings that have been supporting consumer spending could evaporate and return to more normal levels by the end of the year. And with less money in the bank and slowing job creation, that should dampen consumer spending as we progress into the year. Second, we still think there is work to do to correct the excess spending we did on goods during the pandemic. You can see that the spending on services is essentially back to its trend, but that goods spending remains elevated and likely to slow, if not decline. Again, to reiterate, the bottom line from an economic perspective is we expect sluggish growth that leads to a mild recession, but nothing disastrous. And next, Yvonne will be reviewing the topic of monetary policy.
The Fed's main weapon for fighting inflation is to raise interest rates, and that's exactly what they did last year, raising rates at the fastest pace since 1980. Now, we think the Fed is nearing the end of its tightening cycle and only expected to raise interest rates 2 more times this year to 5%, and then likely remain on hold for the remainder of the year. The reason we think the Fed is in the late stages of raising interest rates is that its actions are already starting to have an impact on the most interest rate sensitive parts of the economy. For instance, in the housing market, higher interest rates have lifted mortgage rates by an average of $14.75 a month over the last 3 years, which is slowing the housing market. In the auto industry, car loan rates are making it more challenging to afford a car. And then for small businesses, loans have spiked to the highest level since 2008, which makes businesses more hesitant to expand. The other reason we think the Fed is close to being done is that we're seeing inflation cooling broadly and very quickly. Across the board, you're seeing more and more evidence that it's slowing, whether it's in gas prices, used vehicle prices, you're seeing the reduction in services, and even in food and shelter, and so things like rent and home prices.
If the pace of headline inflation continues on its current path, our economists believe it could easily fall to the 2.2% level by the end of the year, which would be a welcome sign of news for the Feds. Another favorable dynamic from the Fed's point of view is that consumer expectations of inflation going forward are trending lower. which means that the persistently rising price mentality is not getting permanently ingrained. If we are correct and the Fed ends its tightening cycle by the first quarter or by early second quarter, it will be a favorable development for the equity and fixed income markets. The chart on the left shows that after the last tightening, the S&P 500 has historically used that as a springboard to move higher and tends to do well. And similarly, the chart on the right shows that after the last tightening, the 10-year Treasury yields tend to grind lower, which is a positive thing for the fixed income markets. And next, we will be talking about market volatility. Our expectation is that volatility will be less this year compared to what we experienced in 2022. When taking a look at last year and everything thrown at the markets, it should be no surprise that the S&P 500 experienced excessive volatility and had the greatest number of 1% moves, both up and down, in 14 years, which was in 2008. There were 122 days of 1% daily moves last year, which is essentially 2 per week, which is very uncommon for us to see. In addition, the chart on the right shows that historically more conservative bond portfolios had its highest standard deviation since 1987. We expect volatility to be dialed back a bit this year because many of the drivers of volatility are likely to dissipate. If you look at the gauges pictured, the red line shows 2022 risk levels. The orange lines show our expectations for 2023. From an economic perspective, inflation has peaked and is likely to move lower, which should allow the Fed to end its tightening cycle. The recession is likely to be mild, but importantly, our sights and discussions are likely to move to coming out of the recession, which leads to a positive outlook. And domestically, right or wrong, most of the population has moved on from COVID and returned to their normal daily activities. There's a very limited probability of any more shutdowns. And in Washington, while political debates will remain, major policy changes will be non-existent because of split government. Even the threat of a government shutdown may be overblown, as history shows that has not been beneficial to the party that initiated it. And when you take a look at global risk, the impact of Russia and Ukraine war will get less and less as the economic impact from high energy prices gets dialed back. By the way, the transition of Europe away from Russian gas has been much quicker than anyone anticipated. If hostility eases in Russia and Ukraine, it would be a very positive catalyst for the markets. The biggest upside catalyst could be the likely of reopening of China, as it will reduce supply chain bottlenecks and provide an upside catalyst to global growth. To the right shows the results from a sentiment survey when asking people to identify the biggest risk to the market. The two main responses were monetary policy error and geopolitical risk. The point is, if everyone has already identified these risks, historically it's already been priced into the market. So we think a lot of the risks have been baked in and we expect to see less volatility.
For the first time in a long time, bonds are looking very attractive. Part of that is because of the year we're coming out of for fixed income. The chart on the left shows that a drawdown in investment-grade credit was unprecedented, as it was down 22%, which was much worse than what we saw during the Great Financial Crisis when default risk was much higher and corporate fundamentals were significantly worse. So in many ways, we believe the negative performance is overdone and that bonds should rebound nicely this year. The chart on the right shows the opportunity. The circles at the bottom are where rates were a year ago. The shaded bubbles are where rates are today. To put it in perspective, you can get almost the same yield from a 3-month Treasury bill today as you had from a high-yield junk bond a year ago. Bonds should perform better for 3 reasons. First, bonds tend to perform well after the peak in inflation, which we believe occurred last summer. In fact, 12 months later, bonds are positive 85% of the time. Second, historically, bonds tend to do well after the Fed ends its tightening cycle. And again, 1 year later, the bond market tends to be up 100% of the time and in solid positive territory. And third, bonds should get some increased investor demand as they truly now provide superior income versus equities. In fact, the yield on the U.S. aggregate bond index is more than 2.5% greater than the dividend yield on the S&P. The largest differential we've seen since 2008. As a result, we believe these three dynamics will help interest rates grind lower through the year, with our forecast for the 10-year Treasury yield hitting 3%. When it comes to where to invest in the bond market, we continue to favor high-quality bonds, with our preference for Treasuries, municipals, investment grade, and emerging market bonds.
Turning to the next topic, we'd like to expound on the equities market. While it was a difficult year for equity markets, history suggests more favorable trends moving forward. We can see that it is very rare to see back-to-back negative years for the S&P 500. In fact, it has only happened 3 times dating back to 1937, and when it has occurred, there has been serious circumstances such as World War II in the early 1940s and the oil embargo and severe recession in the mid-1970s and the tech bubble in the early 2000s. Dynamics we do not see today. Second, what hurt the markets in 2022 was PE contractions as earnings growth were positive. This was the second year in a row that we saw these contractions, and what is notable is that we have not seen 3 years in a row since 1994, so almost 30 years. Third, if you look back at the last 4 bear markets, they have tended to bottom or see a significant springboard out of the bear market during first quarter. And if you look at some of the potential catalysts such as inflation decelerating, the Fed ending its tightening cycle, and earnings coming in better than feared, it could happen again this year. And then fourth, remember, we are in the 3rd year of a presidential cycle, and that tends to be the strongest of the first 4 years in office. Historically, it is positive 92% of the time and up double digits. In all, we expect the S&P 500 to rally to about 4,400 by the year end. Again, that's not based on history, but relies more on solid fundamentals. It's important to keep in mind that markets are forward-looking indicators of about 6 to 9 months. From a macro perspective, you can see that the S&P 500 actually bottoms 3 to 4 months before the recession ends in anticipation of the recovery, which is depicted on the left. The chart on the right shows that, in fact, inflation peaked. The markets tend to rally 90% of the time 1 year later and is up double digits. The point is, we have a much more constructive view on the equity markets than most, and the fundamentals suggest that the equities market can move higher this year.
Turning now to industry perspectives. The 4 areas of defense that we believe provide investors with opportunities include national defense, cybersecurity, oil security, and reshoring. A lot of governments believe in peace through strength. As such, we're seeing a lot of countries investing in and building up their military. This should continue to support demand for aerospace and defense. And as wars are not just fought on the battlefield anymore, cybersecurity becomes increasingly critical. A cyber attack occurs every 40 seconds here in the United States. The cost of all cybercrime damages and losses in 2021 was $6 trillion. That would equate to the 3rd largest economy in the world. Another critical part of national security is energy independence. As we rebuild our strategic petroleum reserves and try to support our other allies, this should continue to help the energy sector as well as renewable energy. And with a lot of companies being incentivized to come back to the U.S., we should see long-term benefits from reshoring in sectors such as electrical and transportation equipment, chemicals, medical equipment, and medical supplies.
This year, it is paramount that investors return to basic investing principles and let fundamentals drive portfolio decisions. Looking back through history, there have been a number of asset bubbles. Some of these include gold during the 1970s and 80s, the dot-com bubble in the late 90s and early 2000, and the home builders during the run-up to the housing crisis. But each of these cases ended for the same reason. The fundamentals did not justify the run-up in prices. But as you can see in this chart, over the last year, some of the more speculative areas of the market, such as meme stocks, crypto, and other companies with no earnings, were hit the hardest in 2022. A basket of the most popular meme stocks were down almost 70%, Bitcoin was down over 60%, and companies with a negative full year of 2022 earnings were down almost 45%. Why were they hit? The fundamentals were not able to justify their valuations, and we believe we are going into a market that is focusing more on these fundamentals. Just look at what outperformed during the last year. While they were still down, companies that had the best earnings growth or were the cheapest were only down about 13%. That trend is likely to continue. Investors will have to focus more acutely on the fundamentals in 2023. And that concludes our presentation for the outlook for 2023. Thank you, everyone, for your time and for listening, and we hope you have a great rest of the day.
Thanks, Asia. Thanks all. Have a great day.